let's get to the fact that you cannot have a real rally without the financials playing along, and the banks don't like what they heard today for some reason. Let me bring in former Lehman Chief Financial Officer Brad Hintz. He teaches at NYU Stern School of Business right now. Brad, the banks don't like this. At first, the big names, the Morgan Stanley's, JP Morgan's moved higher, but now they are not doing so. What should we infer from the behavior of those stocks as it pertains to what Janet Yellen did about an hour and a half ago?
What Yellen said is the economy is doing well and she's going to raise rates. And in that, you'll find that a portion of the banks are going to do very well. The banks' deposit bases are worth more. And so in a rising rate environment, you get rising net interest margin. That's good for the banks. In the initial part of a rising rate environment, the foreign exchange and the fixed income guys actually do very well. So you can kind of look forward into Q1 and say the trading businesses will probably do reasonably well in that kind of an environment. Longer term, the issue is, you see certain parts of it that slow down. Mortgages, right? As rates rise, mortgages will begin to, mortgage origination will slow. It's more costly to do mortgages. People don't do refinancing. That's going to slow down people like a Wells Fargo, right? So, it's the classic. On one hand, it helps. On the other hand, it hurts. So certain stocks are going to do well by rising rates. Others, you get both effects, right? They can look forward and they can say net interest margins are going to do well. But what Charlie said is right. At some point, you've had banks that have run up, and how much further can they go, and how long will the continued rally in the economy continue?
Stand by. 3 minutes to go before the trade. I want to bring in, can I grab you for a second?
Sure, absolutely.
Can I tell you what you see here? We're going back down. This is Tim Anderson, one of the smartest traders on the floor here, down 127. What happens tomorrow? Let's spin it forward.
I actually think the market's acting very rationally right now. You've got the transports down about 1.5%. You've got the Russell down about 1.25%. Those are steeper declines in the Dow and the S&P and NASDAQ. And those are the segments of the market that have had the sharpest increases since November 3rd when the rally began. The transports had about a 16% move up, and the Russell was up as high as 20%. Right, exactly. So I think that you've got some correction and some rotational action going on. The banking sector of the financials is actually acting okay right now. There may be inch to just fractionally higher, and some of the technology stocks are actually still in the green.
Tim, I know you've got to run because the traders have to be completely focused and on the phone with their clients. When we have 2 minutes to go, that's what we have. Brad, when we're looking at, I'm glad you just brought up what matters to people who have savings accounts. This is good for savers, isn't it? Rates moving higher. Not great for who? People who have car loans, right? Because then the interest rates go up on that.
Exactly. What you're going to see is you're going to see credit cards, you're going to see car loans immediately rise with rising rates. Over time, and as rates continue to rise, you'll start seeing the deposits go up. So, if you think about that, there's certain places who are certain stocks that'll do very well. Like a Charles Schwab. Charles Schwab has a lot of cash. They have a bank that deposits their net interest will go up. That's going to be positive for a Charles Schwab. We can look at it and say banks that have large deposit bases, the custodial banks, State Street Bank in New York, the deposit bases have more value to them in a rising rate environment. You can look at the movement itself and say the movement generates value. The Chicago Mercantile Exchange. If interest rates rise, everyone has to hedge interest rates. And so you see banks hedging interest rates, corporate treasurers hedging interest rates. Every time they buy a contract, it's 25 cents to the CME.
Okay. Brad Hintz, thank you very much, Professor.